Are you considering investing in mutual funds but need help knowing where to start? This video lists the top 3 things to remember when investing in mutual funds. From understanding the fund's objective and investment strategy to analyzing its performance and expense ratio, we cover everything you need to know to make informed investment decisions. Whether you're a beginner or an experienced investor, this video is a must-watch for anyone looking to invest in mutual funds effectively. So tune in now and start making smart investment choices. When investing in mutual funds, there are 3 key things to keep in mind. A fund's objective and strategy refer to the goals and methods the fund's manager uses to invest the money in the fund. The fund's objective is the specific financial goal that the fund is trying to achieve, such as growth, income, or capital preservation. This objective is usually stated in the fund's prospectus and can help investors determine if the fund aligns with their own investment goals. The fund strategy refers to the specific methods and techniques used by the fund manager to achieve the fund's objective. This can include investing in particular types of securities, such as stocks, bonds, or real estate, and following specific investment styles, such as value investing or growth investing. By understanding a fund's objective and strategy, an investor can determine if the fund aligns with their own investment goals and risk tolerance, and whether it's a good fit for their portfolio. A fund's performance refers to how well the fund has performed in the past, usually measured by its returns. The returns of a fund can be measured in various ways, such as total return, which includes both capital gains and income, or price return, which only includes capital gains. When evaluating a fund's performance, investors should compare it to similar funds in the same category, such as those with the same objective or those with the same type of securities. This can help investors determine if the fund has performed better or worse than its peers over a certain period. It's also important to note that past performance is not a guarantee of future performance, as the market and economic conditions can change. Therefore, it's essential to look at other factors while evaluating a fund's performance, such as management team, expense ratio, portfolio composition, etc. Additionally, it's also essential to consider the volatility of the fund's returns, which can be measured by standard deviation. This will give an idea of how much the fund's returns have fluctuated in the past. The expense ratio is a mutual fund's annual fee to cover its operating expenses. It is expressed as a percentage of the fund's average net assets, and it is deducted from the fund's returns. The expense ratio includes management fees, administrative costs, and other expenses associated with running the fund. The lower the expense ratio, the more your investment will go towards earning returns, and vice versa. When evaluating a fund's expense ratio, it's essential to compare it to similar funds in the same category, as expense ratios can vary widely among funds. A fund with a higher expense ratio may be a good investment, but it's essential to consider the expense ratio with the fund's performance and other factors. Investors should also be aware that some mutual funds have a front-end load, a sales charge paid when you buy the fund, and a back-end load, a redemption fee paid when you sell the fund. It's also essential to consult with a financial advisor or professional before making any investment decisions. Keep an eye on the mutual funds you're interested in and stay current on any news or developments that may affect the fund's performance. Remember to like and share the video. And if you still need to subscribe, then click on the red subscribe button to make it gray. And while you are at it, click on the red bell icon to get notified when we post another video.